Ernest Hemingway once said about fishing, "Every day is a new day. It is better to be lucky, but I would rather be exact. Then when luck comes, you are ready." The first half of 2022 has been a tough one for the market, but it's times like this where outsized movement creates a lot of opportunities. Like Mr. Hemingway suggests, we believe in staying prepared and exact in casting our net into the water where more fish look ripe for a bite than have for quite some time. Will luck come our way in the second half? Let's take a look.
The Federal Reserve has made it clear they will continue raising rates in an effort to slow demand and contain inflation. In light of that hawkish approach, most investors are skeptical of the so-called soft landing scenario, whereby growth slows but does not go negative before the Fed completes their goals. The stock market has been behaving recently as if a recession is already at our door, and there are several economic indicators pointing to a swift deceleration in economic activity. It's even possible that a mild recession is already here. Data at the end of July will confirm that one way or the other. In this environment, stocks representing a variety of industries have largely been moving in sync with one another. That's both good and bad. Certainly, there are legitimate issues weighing on stocks, but when they are all treated equally, without regard to the particular nuances of each individual business, opportunities should arise. There are times, last year's a great example, when stock appreciation makes it tough to find new companies that are attractively priced. The term overvalued gets press, as does the term fair value. By the end of 2021, a ton of stocks were fairly valued and quite a few were overvalued. With the broad sell-off in recent months, there is now an argument to be made for finding stocks that are potentially undervalued. It's been a while since we could say that. So where are we looking? Many hyper-growth-oriented stocks have corrected substantially, but the market still seems uncertain as to the fair value of their future earnings. On the other hand, there are a growing number of quality stocks in healthcare and financials and industrials, and even a few in tech land that look more appealing than they have for several years. That is not to say that further declines are not in the cards. But as Peter Lynch once famously said, the key to making money in stocks is not to get scared out of them. We are looking for good businesses, compounders that generate a lot of cash, led by exceptional management teams exhibiting some positive change that leave them well positioned once general market pessimism recedes. That means going ahead and establishing new positions, knowing things might stay choppy for a time. Just like when fishing, when little seems to be going right, it is important, as Hemingway suggests, to focus on staying exact and looking for clues as to who will emerge as the future winner when better times return. We don't find these markets any more enjoyable than anyone else, but they can be rewarding if adjustments are made to capture positive risk-reward and long-term opportunity. Thanks very much for watching.